All right, so welcome to chapter 1, where we'll talk about accounts receivable. So for this chapter, we'll look at AR, we'll account for bad debts, we'll talk about how to estimate bad debt, what it means to create a notes receivable for that AR, how to manage AR, how to measure the effectiveness of your AR, and how to dispose of them. So you may recall that accounts receivable is created when you've created a sale of a good or service to a customer and they've committed or agreed to pay you at a future date. Your revenue recognition says it can only be recorded when goods are sold or when services are performed. And there are different criteria under IFRS or ASPE that consider a sale of good or service. When we look at sales of good, it's when the transfer of ownership or that the seller no longer controls that good, it's considered a sale. If you can measure the revenue reliability of that good, it's considered a sale as well. On the service side, again, if you can agree upon the amount of revenue that's earned between the buyer and seller, it's considered a sale. You can also look at stage of completion, or the cost related to the sale can be measured. So you can relate the revenue with the fact that you've incurred costs on a sliding scale. And we'll go through an example in a second. So let's do a little example. We have this company called Catch Construction. They signed a contract to build a condo building. They're going to start on June 1st, 2020, taking 2 years. They're charging $500 million. That's their sales value for the project. And they're expected to incur costs of $400 million over the 2 years. How much revenue should be recognized in 2020? In this case, we'll use the percentage of completion, where we look at the actual costs incurred in the current year divided by the total estimated project costs. We'll create a little chart that looks at the 2-year project span, which covers 3 fiscal years, 2020, 21, and 22. And we'll look at the total costs incurred and we'll say that we'll incur a cost of $100 million in the first 7 months of the project in calendar 2020. We'll incur costs of $280 in 21 and $20 million in 2022. Doing the math, looking at $100 million of cost divided by the $400 million in total, we'll have 25% percentage of completion in year 1. Similarly, year 2, we'll have 70%. And in year 3, 5%. So that totals 100% of total costs over the 3 calendar years. We'll look at the revenue recognized. We have $500 million to earn over the project period, and we'll apply that to the percentages calculated. So in 2020, we'll earn 25% of the $500 million to be $125 million. Second year, similarly, 70% of the 500 for $350 million. And then 5% in the third year of the 500, or $25 million in earned revenue for 2022. Now we'll flip over to accounting for bad debts. Bad debts refers to you've created a sale to a customer and they might not be able to pay and it becomes uncollectible. It is considered an operating expense. And there are 2 accepted accounting methods for doubtful accounts and bad debts. There's a direct write-off method. Once it's been reported, you record the bad debt, or there's the allowance for doubtful account. And we'll go through both methods. We'll talk about these approaches shortly. Direct write-off method says the customer's told us that they can't pay. So in this example, on March 3rd, a company told us they're unable to pay the outstanding balance of $5,000. So we debit bad debt expense for $5,000 and credit that account receivable for that customer for $5,000 to remove it from our balance sheet. However, maybe months later, we're told by that customer, we've already written off the account, they're able to pay it now. In this situation, we need to reinstate or recreate the accounts receivable for that customer. So we'll debit the accounts receivable to add it back to our balance sheet for $5,000, and we'll reverse the bad debt expense. So we'll credit the bad debt expense for $5,000. Then we will record the payment on account, being a debit to cash because they've given us cash, and we'll credit our AR to clear out the AR for that customer for $5,000. couple of workbook exercises noted at the bottom if you decide to do some practice. Another situation is we have this company, they sell refurbished and antique furniture, and we allow customers to charge on account, and we generally collect 100% within 30 days. However, in 2020, our sales were $2.5 million, and it has a December 31st year end. In January 2020, one of our customers called to say that they were filing bankruptcy and were no longer able to pay the amount owing, being $3,500. However, 2 years later, they paid it. We're asked to give the journal entries, record the sale, the write-off, and subsequent collection. So we'll have a number of journals. First of all, we'll set up the AR, we'll set up the AR for the original sale, credit sales to earn the revenue, $3,500, with the accounts receivable for $3,500. They've told us that they couldn't pay, so we reversed their accounts receivable in 2020 for $3,500 and created a bad debt expense, being an operating expense on their income statement. 2 years later, in 2022, they've said they can pay it now. So we need to reestablish the accounts receivable for the customer. So debit AR, $3,500, and we'll credit the bad debt expense for $3,500. And then they paid us in that same year, 2022. So we'll debit our cash and credit the AR. So now there's no accounts receivable outstanding for that organization in the amount of $3,500. Under the allowance for doubtful account method, it's where we've created an estimate of AR. So in this case, we've got an example. We've estimated $5,000 of AR may not be collectible. So we'll debit the operating expense being bad debt, $5,000. Then we'll credit a contra to AR called allowance for doubtful accounts, AFDA, allowance for doubtful accounts for $5,000. So on the balance sheet, it creates a contra, an opposite account to AR. So it sits on our assets and it's netted. So if our AR balance was $100,000 and we have a $5,000 allowance, our net AR on our balance sheet will be $95,000. That's what would be reported on your balance sheet. Once we've set up bad debts for the allowance for doubtful account, different scenarios can exist. First of all, a customer is unable or unwilling to pay the debt, and it's considered uncollectible. So in this case, we will get rid of their AR. So we'll credit the AR for that customer of $5,000, say, and we'll debit the allowance for doubtful accounts for $5,000. We've already put the bad debt expense on our operating statement. So we're writing it off to the balance sheet account, AFDA. Once an account's written off, the customer tells us that they will pay the amount. In this case, we need to reestablish the AR. So we'll credit the allowance for doubtful accounts and debit the AR for that customer for the amount that they're going to pay us later on. And in this case, we said it's $5,000. And then we will record the receipt just like we do in the other scenarios with the debit to cash and a credit to AR. Thirdly, a customer is unable to pay the debt when it's due, but will be able to pay it in the future. So if they're going to pay it in the future, we don't do anything. The AR remains on our books. All right, so there are different approaches on how to estimate bad debts when using the allowance method. First approach is using the income statement. So in this situation, the income statement approach, we also can call the percentage of sales method. And because it looks at credit sales on the income statement and uses it as a basis to estimate the future bad debts. The percentage applied is typically based on what we've experienced in the past. So, example, if our collection history says that about 1% of our credit sales will result in bad debts, and we're also told that credit sales for our company was $1 million. So in this situation, we'll take the $1 million times 1%, giving us 10,000. And our journal entry then would be to debit our bad debt expense for 10,000 and set up the allowance for doubtful account, AFDA, for $10,000. Again, the contra account to our AR. Various workbook exercises noted below. Another example says we have this company that uses the income statement approach. And for the year ending December 31st, 2020, we have credit sales of $1 million, but our estimated bad debt expense is 5%. And we're asked to prepare the journal entry for the year. In this case, we'll take $1 million times 5% or $5,000, and we would debit bad debt expense. Actually, hold on, for 50,000, there's a typo here. 50,000 is 5% of $1 million. Sounds better. So we would debit bad debt expense for 50,000 and credit allowance for doubtful accounts for 50,000. All right, so carrying on to the balance sheet approach, we can look at the percentage of total accounts receivable method. So we can look at our AR balance at a point in time, say it's $200,000, and our experience is that 4% will become uncollectible. Our allowance for doubtful accounts should be 4% of $200,000 or $8,000. The other method is the aging method. So we look at the age of our accounts receivable in different buckets. And in this example, we've looked at 30 days or less, 31 to 60, and more than 60 days. And we have different bad debt percentages applied to each range. We look at our balance of AR in those ranges. You can see in our table, we have $80, $90, and $30,000. And our estimated debt would apply the bad debt percentages to each bucket for a total in this scenario of $5,800 once we add up all three buckets. So let's assume that the $5,800 of the AR, a balance of $200,000, is estimated to be uncollectible. And we have a few different scenarios of what can happen. If our allowance for doubtful accounts has a balance of 0 to begin with, we would then debit the bad debt expense for $5,800 and credit the AFDA for $5,800. Sometimes our AFDA might have a balance other than 0. In an example, if it was a credit balance of $3,000 and we need to have a credit balance of $5,800, we would need to do a journal entry for the difference, being $2,800, because we want to increase the balance, the credit balance of AFDA to $5,800. So we would need to credit the AFDA by $2,800 and debit our bad debt expense for $2,800. So the opening balance of 3 plus the journal entry of 28 will give us the balance of $5,800 required. In a third scenario, maybe our AFDA has a debit balance. That's where you wrote off more than what was in the allowance during a period of time. And we need to reestablish it to be $5,800. In this situation, we got to go from a debit balance past 0 back to a credit balance of $5,800. So we need to do a journal entry for $6,800, credit the AFDA, and debit the bad debt expense. All right, so let's go through another little example, and we use the balance sheet approach to estimate bad debt. Details of the accounts receivable are shown in this part below, and we need to prepare the journal entry, record the bad debt expense, assuming that the AFDA has a $20,000 credit balance already. So we have the different categories. What we believe is uncollectible is a percentage of 1, 20, and 50% against the balances in each of those buckets. So we'll do the calculation. 90,000 times 1% is 900. 90,000 times 20% is 18,000. 30,000 times 50% is 15,000. So the balance we want in our AFDA is $33,900. Because we have an opening balance of 20 currently in our AFDA as a credit balance, it says we need to credit it for $13,900 to get the AFDA up to the balance that we desire. So in this situation, we will credit the allowance for doubtful account for $13,900, and we'll debit our bad debt expense or operating expense for the same. All right, so we've got another example here that we've got the different categories, and we're assuming that the AFDA has an opening debit balance of $1,100. So we'll go through the same calculation: 76,000 times 2%, 45,000 times 3.5%, and 25,000 times 10%, for a total AFDA balance expected of $5,595. In this situation, because we're going from a debit balance to a credit balance, we have to add the two numbers together. So we have the $5,595 that we want, plus the $1,100 that we need to offset to get to 0, which means we need to do a journal entry for $6,695. That is the amount that we would credit the AFDA for. and debit our bad debt expense. All right, moving on to notes receivable or a promissory note. So we have a customer that sometimes might agree, hey, I can't pay you today, but I'll pay you at X date in the future. So we move it from an accounts receivable to a note receivable. And an example could be we've issued a promissory note between ourselves and a customer on January 15th. Face value of the note is $1,000. Annual interest rate is 8%. Maturity date is March 16th. And we calculate the term of the note. So we look at the days in January, 31. We issued it on the 15th, so it's 16 days in January, plus 28 days in February, plus 16 days in March, for a total of 60 days is the term. To determine the interest earned in that period, we'll look at the $1,000 note receivable times the 8% per year, times the number of days out of the year. So we'll look at 60 days out of 365 days in the year. So the total interest that we expect to earn in that period is $13.15. All right, so another little example. On April 1st, we have a customer who had $1,000 in outstanding AR with us, and she can't pay us right now. So our company has agreed to give her more time, and interest will be charged at 6%, and she agrees to pay a year later on April 1st, 2021. So our first entry on April 1st, 2020 would be to move the accounts receivable for this customer, so credit AR, to a notes receivable, so debit notes receivable for the $1,000. It's between different buckets on our assets. On October 31st, we prepare our financial statements and we need to accrue the interest earned. So if the interest earned is 6% per year and we have 7 months period passed, which is April 1st to October 31st of 2020, we need to do a calculation. It looks at $1,000 owing 6% in 7 divided by 12 months means we should earn or accrue $35 in interest for the first 7 months. And just to continue the balance of the term, we've got the calculation showing the balance of the term being 5 months remaining. So 7 months plus 5 months is the whole year, which means in 2021, we will earn $25 of interest on this note receivable. So our journal entry as of October 31st will be a debit to interest receivable. So it's an amount owing from a customer of interest $35, and we'll credit the interest revenue of $35. So now we're looking at the maturity date, where for an example, the note is paid in full. The customer gave us cash of $1,060, which includes the $60 in interest. And we have to clear out the accounts receivable of $35, so we'll credit the interest receivable, but then there's an additional $25 in interest revenue for the current year, 2021. So we'll credit interest revenue of $25. And then we'll credit the notes receivable, the original principal value of the note, of $1,000. So this gets rid of the notes receivable, that gets rid of the interest receivable, and this earns the balance of the interest revenue. If the note is not paid, but the note is mature, we now need to move it back to an aged AR. So similarly, you still need to get rid of the interest receivable, still need to earn the interest revenue, still need to get rid of the note receivable of $1,000. But instead of going to a debit to cash, it's a debit back to AR for that customer of $1,060. So the note's matured, it's gone, it's done, it's dealt with, but now the customer still owes us $1,060. Again, some workbook problems as examples. All right, so now we're going to move on to various ratios. So one example is the accounts receivable turnover ratio. You might have covered this before, actually, in Accounting 1100. So the ART measures how often does the accounts receivable turn over. Okay. So how we calculate that is the net credit sales divided by the average net AR. So an example, we have a company that has an average AR of 200,000, net credit sales of 1.2 million. In that example, it turned over 6 times, which tells me basically every 2 months, our accounts receivable is collected, which in my opinion isn't great. Another example, I have a net AR of 135,000, net credit sales of 1.65 million. In this case, it turned over 12.2 times. So less than a month, every month, our AR is turning over, which means our customers are paying us typically in less than a month, which in most cases is pretty good. So I would say the ART ratio is better for company 2 than company 1, in my opinion. Another ratio we look at when looking at accounts receivable is the days sales outstanding. So it's how long do customers typically take to pay their bills. And this formula is average net AR divided by net credit sales times 365 days. So example, company 1, the net AR is 200, the net credit sales is 1.2 million. The days sales outstanding for that company then is 61 days. So typically it takes 61 days for a customer to pay their balance owing. Company 2, similar to the previous slide, net AR of 135 and net credit sales of 1.65 million. Our days sales outstanding in this case would be 30 days. So typically our customers pay us within 30 days, which again is much better than 61 days. Again, some workbook examples. I think the last couple things we'll cover is disposable of receivables. So sometimes you might have AR on your books that's aging and you want to get rid of them. And you have options. Sometimes companies can convert them to cash by either factoring or selling them, or using them as collateral to secure loans. So you gain cash by using them as collateral. So for example, we've got this company that wants to dispose of $50,000 of its receivable by selling to the bank for exchange for cash, but the bank charges what we call a 5% factoring fee. In this case, we've gotten rid of our AR because we've given our accounts receivable collection and our customer list to the bank. So we'll credit AR for 50,000. The bank's given us 47,500 because there's a 5% or $2,500 what we call factoring expense. That's an operating expense to our business of 5% of the value of the AR. So the bank gave us $47,500. Typically, the factoring fee is much larger than that from what I've seen, but this is one example. Another situation might be where you pledge the receivables. So we have a company that wants to borrow $45,000 from the bank, and we pledge $50,000 of our receivables as collateral for the loan. So it's collateral. Our AR stays up to our responsibility to collect, but we're giving cash of $45,000, and now we have a liability on our books of notes payable of $45,000. And the idea is if we don't pay that notes payable, any cash collected from accounts receivable here is owed to the bank that lent you those funds. So that's all we have for this chapter. Please email me any questions. And we'll see you possibly at the drop-in sessions.